Hi folks, Hedley Widdup here from Lion Selection Group in Melbourne. I'm talking to a selection of slides which cover off Lion's quarter, which was February, March and April 2022. The quarterly report went up on ASX at the end of May. We've had a range of new shareholders come onto the register in recent months, and likewise we've been trying to get around and talk to as many shareholders as we can. So these videos are a productive way of trying to extend the understanding a bit of what's going on inside the business. And if any shareholders have any questions, we invite you to either call the office number or come through to us on the inquiry email address, and we'll get back to you as quick as we can. We can also incorporate the answers to the common questions which we get in these kinds of presentations, which we'll do every quarter from now. Standard disclaimer there. I'll leave you to go through that in your own time if you'd like. So the quarter, which ended at the end of April, has been a transformative one for Lion. The first event and a main event for us during that quarter has been the closure of the Pani deal. The Pani sale was announced at the end of January. It was closed in early February. So Lion has received US $22 million of cash. That's been repatriated, sits within the NTA as Australian dollars now. It's received $20 million worth of Merdeka stock. And that stock has performed quite well in the interim, and come the end of January 2023, there is a final deferred payment of up to $10 million US, which is adjustable dependent on the performance of Merdeka shares. So if we enjoy some great performance on Merdeka, as we are at the moment, then we'll receive less cash. But Lion can't take any less than $30 million out of that deal as the closure between the two of them. So it's a wonderful windfall which is yet to come there for Lion shareholders. First time since 2009, Lion has paid a dividend, 3.5 cents unfranked special dividend was paid at the end of April. There's the outlook for further dividends. The end of this year, late 2022, approximately November, another 1.5 cent annual dividend will be paid, and the board is quite clear about the perception which is created when you say this is an annual dividend. So there is an expectation that will be paid into the future to come. So come the end of most calendar years, I think we can probably expect there'll be a dividend of some kind for the next little while. And the board intends to consider a further special dividend in the first half of 2023, which will follow the final exit, if you like, from Pani when we assess the value of the Merdeka shares and receive the $10 million of deferred cash. So there will be an extra amount paid to shareholders at that time. We've re-established or established, if you like, an on-market buyback. The purpose of that is to try and provide liquidity if there isn't any, and also to generate a little bit of turnover on the register. So Lion's been buying its own shares at a terrific price. You can see on the left-hand side there what the NTA is and the share price. Lion's been buying at a bargain level there. One of the biggest things which has occurred during the quarter has been the recommencement for the first time in a long time, since we've been focused very much on the Indonesian assets, which Lion used to own, Pani, and before that Nusantara as well. Lion's been able to refocus itself on new opportunity investing, and there's been a tremendous amount of new opportunity assessments take place with a long list of meetings and follow-ons to go on from many of those. We've made the first investment under that program, Great Boulder Resources. I'm going to talk about that in just a moment. And whilst it's not the focus of new investing by any means, Lion saw the opportunity to take up an entitlement issue in Merdeka, which was deeply discounted. And by function of the time in Indonesia where you have to announce this kind of a rights issue and then execute it, Merdeka had performed very well in that time. So it presented a real windfall price. So Lion took up its rights there and sold them instantly and was able to generate a very handsome little profit on what was essentially a couple of nights deployment of the money. And we're very actively seeking and assessing new opportunities for Lion to be investing in, either to hold for the longer term, but also established a smaller pool of investing funds which are available for smaller volume and perhaps shorter duration investing. Just before we move on, the NTA at the end of April sat at 68, almost 69 cents versus the share price at the time, which hasn't changed too very much in the meantime, of 48 cents. So Lion is trading at a considerable discount to what is a high quality cash or value protected NTA. And I think the reason for that is that when you write down what the Pani transaction generated for Lion, it's not tremendously clear, just because of the nature of it, exactly what that's going to be worth at the end of the period where Lion finally walks away from that. It is very valuable, and I think whilst we're still holding the Merdeka shares, there's probably a degree of misunderstanding about what exactly their value is to Lion. So I'm going to try and address that. But if you were to turn the Merdeka shares and generate that $10 million deferred cash payment right now, Lion would be sitting here with a NTA which is approximately 90% cash backed, with a small residual portfolio which is left over. So the 48 cents is well below what is the notional cash backing if you just work through it from that perspective. Merdeka is Indonesian listed. It's listed on the IDX. It's a large company. So in their most recent presentation, they outlined an enterprise value of their business of almost 10 billion US dollars. So it's up there with some of the ASX listed mid-tiers, and it has some stunning assets. Its largest piece of value is a undeveloped copper deposit, which has a reasonably high-grade copper and gold component to it in Indonesia. It has a small gold mine on top of that, and by small I only mean in respect to the copper deposit which they hope to develop into a mine. It generates in excess of $100 million EBITDA and is very, very profitable in its own right. They're developing a project which is going to process base metal mining waste material from one of their other projects in Indonesia and generate acid and a suite of other metals. And in between the time where Lion received its Merdeka shares and now, they've dealt into a very, very reasonably sized and already developed nickel business in central Sulawesi, and are developing further producing capacity at those assets. So they're turning their business from copper and gold into copper, gold, nickel, and moving very strongly into the battery materials sector there. Lion holds about 73 million shares in Merdeka. The entry price was the US dollar 20 million of shares, which was received by Lion as the part consideration for the sale of Pani. At the time that came into Lion's portfolio, it was worth about 36.5 cents per share, as in 36.5 cents per Merdeka share. And the price at the end of April on the same basis and just using spot conversion rates was about 51.7. So it's performed quite strongly since the time that Lion's received those shares. And you can see the chart on the left-hand side there of Merdeka's performance. We're not presenting that in Indonesian rupiah. The agreements which we've written for the sale of Pani referenced US dollars. So that share price that you can see is the Indonesian rupiah price converted into US dollars per share at the daily US dollar IDR exchange rate. And you can see it has performed exceptionally strongly in that time. Turns out a lot of volume. It's highly liquid. The 12-month average daily turnover for Merdeka is 70 million shares. So it's almost the volume of Lion's holding in a day. It would not be difficult for Lion to exit this if it wanted to. And Lion's unencumbered in its ability to deal in Merdeka. So if for whatever reason Lion decided to sell, it could. The only reason that Lion would have to consider holding on to that for longer, and we do think that it's probably going to be early 2023 when Lion does exit this position rather than any time in the interim, is that the deferred cash payment is calculated at the time, at the end of January. And if Lion were to sell at a point and have some deferred cash payment still owing to it, and then reach the end of January and Merdeka has continued to perform, it may have eroded further from that deferred cash payment. So for that reason, unless Merdeka has performed exceptionally strongly, then I think it's fair to say that Lion will probably be a holder, but maintain a very, very close watch on what's going on with Merdeka. And we have close contact with the executives there, and we've got a very clear understanding of the business. And of course, Pani, which was Lion's prize asset for some time, sits in a very prominent position within Merdeka's portfolio and is being assessed now. I think there's 12 or 13 drill rigs which are now positioned on top of the hill and drilling away towards a feasibility study, which is going to be delivered in fairly short order from here. Lion's portfolio, if we just break it down really simply, at the moment has almost $43 million of cash. This is all Australian dollars. So of the circa 68.8 cent per share NTA, 28 cents of that is cash. It's earmarked for investment, of course, but at the moment it sits as cash. And if we cast our eyes down the list there, the next two largest assets within the portfolio is the Merdeka shareholding and the deferred cash consideration, which is expected at the end of January. Now, under that agreement, Lion can crystallise no less than $30 million US. So the biggest swing factor really on those is the US dollar exchange rate into Aussie dollars, followed by the performance of Merdeka, which has performed strongly. So the reason that you can see the deferred cash consideration there sitting at 9.8 million Aussie dollars, which is of course lower than US 10 would turn into is because that performance of Merdeka has already been reflected in our calculation of what that cash consideration would be if it was crystallised at this point in time. It'll be calculated at the end of January, so we'll wait to that time to figure out exactly what it is. But there's the guidance for now. And just considering that those are either value protected or at least notionally very easy to turn into cash and expected to in a very short period of time, we're just putting a ring around the net cash that we've got and those three assets. And if it was crystallised at this point using spot exchange rates, Lion would sit with about $90 million Aussie of cash. So by February of next year, we expect that Lion will have a balance sheet which is very, very rich in cash. And on this NTA calculation, that's almost 90%. So to be trading at a 48-cent price versus what is probably 60 odd cents of cash backing, it really is cheap. And that's with dividends which are yet to be received. So for 48 cents, you get 1.5 cents dividend at the end of this year. There's another special to be received, and then probably that 1.5 cents going on into the future after that on an annual basis. So we get a lot of questions about how Lion's value really does break down, and that's quite a simple explanation. But if shareholders would like to call through and understand better how we would get to that 90% of cash backing by the end of January, I'd be more than happy to explain it, because it really has a very, very clear process for that to take place. And that I think the fact that that is not 90% right now, and there's those different assets sitting there waiting to be delivered or crystallised into cash, is probably the main reason that we're sitting at a discount at the moment. As I said, one of the most exciting things for us having exited Indonesia was the ability to recommence new opportunity investing. And this has been a tremendously busy quarter in terms of working through the opportunities which have been coming into our office. We've been seeing things since the point where we knew that we were going to be exiting Pani, or had a very high confidence of it. But the rubber has been able to hit the road in this quarter. And an assessment of a company is not something that you can do in half an hour and then make a decision. There's an awful lot of work that goes into making an investment. Yet we've been able to turn over one or two things quite quickly. As I said at the start, Lion has exercised and sold an entitlement in Merdeka. It's not our intention to be investing or trading in Merdeka. It's a long-term hold until the point early next year where it makes most sense to sell it. But in this case, Lion could see that there was an entitlement to be taken up. It was unable to sell that entitlement, and the difference in the price between the exercise price and the market price was quite remarkable. So Lion was able to take out about 860,000 Aussie dollars as clear profit on that trade. And as I said, the money was really only deployed for a couple of nights. So it wasn't a long-term thing, and excellent for Lion to be able to just take that nice little profit off the side there. We're actively seeking and assessing a number of things at the moment, and at any point in time, there's a priority list of probably 20 or so things which are of direct interest, and we'll turn those over each month as we go. The focus is very much Australia. It's a global mining investment destination of choice, and you hear all of the large mid-tier companies talking about that. It's a fantastic place to be investing, but from a Lion perspective, it's also one of the easiest places to manage. We know Australia better than any other country. It's cheap and easy to travel to for us based here in Melbourne. And we have relationships which cover all of the states of Australia. So we don't find ourselves in a jurisdiction that way where we're wondering about who to turn to or how business gets done in the mining business. We understand all of that very, very clearly already for Australia. And the focus, commodity-wise and project-wise, is to look for projects and opportunities which are between the precious metals, base metals, and battery materials. Those commodity suite present the lowest processing risks that you can take on. There are a variety of things which you can, of course, access within the natural resources market, and some of them are easy to process, some of them are comparatively quite hard. So we're trying to aim for the lower end of that risk spectrum. In many cases, these projects offer the opportunity for off-site investment in infrastructure to be minimised. You don't have to invest in railways and ports and other things to transport most of these things. And in a lot of cases, they're future-facing. So they've got excellent credentials, both in terms of the fundamentals and the ESG factors which go alongside the development of those things and where those products are put to use at their endpoint. And across the suite of those commodities, there's outstanding growth projections. Now, we don't know what the market is going to do in the meantime. I'm sure there's going to be blips, but from the point of view of a long-term investor, you can assess those projects with a great deal of confidence that there's going to be a strong market for them at a point in the future, and that projects will be able to be built. So having recommenced that, the other investment that Lion has made, but still holds during the quarter, has been into Great Boulder Resources. So this is a milestone, if you like, in terms of Lion reactivating its new opportunity investing process. Great Boulder, we've had a relationship for quite some time. There's a couple of Lion's investors who were already shareholders in Great Boulder, and we'd been talking to our shareholders just about how that company was performing. So we had a reasonable understanding right from the get-go there. An opportunity arose through a placement, which we took part in. Great Boulder is drilling at the moment a circa 6 kilometre gold trend. It's already a gold discovery, but it could get quite considerably larger. 6 kilometre long gold trend, about 20 kilometres from Merdeka in Western Australia. So this sits within gold mining heartland of Australia. All the factors off-site around how you make a project work in that part of the world are well beyond doubt. We know you can dig a hole there and take gold out of it. And this could be a tremendously sized, very large hole if it turns into the discovery, which is sort of the excitement which is painted by the anomaly which is seen on the ground there. Great Boulder have drilled about 900 metres of strike of that 6 kilometres, and they're pushing deeper and going alongside strike to extend that. It's an area of the world where there are more than one hungry processing facility. So you can probably understand that as time goes on, and if this turns into a discovery with the resource and they start making a project assessment, there's the opportunity for it to be processed without even having to build a mill. Of course, that's speculating on exactly who owns what at the time, but quite exciting from an investor's point of view, particularly given the capex which goes into building processing facilities. And if that can be avoided, then it could save a great deal of value for the owners of that resource at the point in time that it needs to take place. Our current focus in terms of deploying Lion's money this week, next week, and in the months to come for 2022 is very much in two particular areas. We've established a pool of funding for very, very targeted, smaller volume with respect to the size of investments that Lion normally makes, equity investments, and in situations where there's liquidity that we can sit comfortably knowing that if we get to a point where we decide that an exit is necessary after some of the value catalysts have been delivered, then we can do so quite easily without having to worry about getting stuck there with a larger size holding. So Lion has this pool which is established, which will allow us to take faster advantage and better advantage of some of the exciting opportunities that we're seeing at the moment, and making a very clear case of the market risks that we see. We're in an equity market which has been performing quite strongly until 2022. And if that situation were to deteriorate, then we're in a situation where these investments can either be held and gone on with in a cheaper market, or they can be sold after we've seen short-term value delivered. So quite exciting to be able to get back into the new opportunity investing in that fashion. But alongside that, Lion is also assessing a range of projects that it could own somewhere between a majority or in most cases 100%. So rather than holding an equity investment with people attached, Lion would be the owner of these projects directly. And I hope to be able to say more about those as time goes on. Some of them are tremendously exciting, and really enjoying the assessment of those because of the style of things that we're seeing there. And these things don't appear in the equity market at present. So we're not looking to take a junior into Lion. We're looking to create exposure for Lion shareholders in things which aren't currently available in the equity market for them to access on their own. We're tremendously well funded for that. As I said earlier, come February next year, we expect to have a balance sheet with over circa $85 million worth of cash on it. Of course, that 85 has probably got a dividend extracted, but not investing funds. So that could be the swing factor on that. But very, very strongly positioned, come whatever may, in the market in the short term. Before I talk about the market, we have referred in the quarterly report to some work that Lion is doing behind the scenes here on Lion's status, its entity status. So at the moment, Lion is classified as a listed investment company, which means that Lion reports a net tangible asset each month, and that provides an indication of its portfolio liquidation value. It doesn't capture the upside which is inherent in the investments that we hold, and it gets particularly challenging quoting an NTA for large chunks of value which are illiquid investments like Parney that we had, or if we take on a project, what is that worth? It's not necessarily transparent to be saying this is what we've spent on it, although that is a fact. It doesn't tell you how much it should be worth. So we hope to be able to determine whether there's a better argument for Lion to just be converted to a mining entity, as in the same as an exploration company or a mining company would be classified as, which would mean in the financial review it appears under the resources stocks rather than the LIC tables, which only appear on the weekends. Lion would be subject to ASX and JORC requirements for all of its disclosures, so nothing's going to change in terms of transparency of the business. But we feel very strongly that this would enable Lion to be able to talk and receive recognition from the market around the value which is inherent in its investments, particularly the ones which have a deep value argument attached to them, which is the kind of investments that Lion seeks to invest in and hold for quite some time. So we're doing a lot of work on that. And one consequence of that, one of the biggest questions or most common questions we get from a number of shareholders is, if you stop being an LIC and you start being a mining entity, what does that mean for the external manager? Do you need to have an external manager? And it's an excellent question, because there are no mining companies listed on ASX that have an external manager. There's a lot of LICs that have an external manager, but that's not necessarily a requirement to be an LIC either. So there's an independent commission of the board, or a committee of the board, which has been formed, which will talk to, negotiate, discuss with the manager all the aspects of how that interacts with the conversion of entity status as time goes on. And when we're in a position to be able to say more about that, then we'll be publishing something that can go to shareholders, and spending time going around as many shareholders as we can to gather their feedback, opinions, and determining exactly how well that fits with other shareholders' opinions as well. So rest assured, that's not something which is just going to happen. There's a fair bit of work that needs to be done within that. And irrespective of the outcome there, Lion's objectives and ambitions remain exactly the same as they always has been, which is to generate value from the kinds of investments that we make, and that is in the early stages of the mining sector, projects that can be developed into mines, whether that's in equity or investing directly in the projects, and then converting that into value for shareholders, either in form of capital appreciation or by, particularly from excess profits, being able to provide an ongoing dividend, which is something that the board is very, very focused on. Lion's been around for 25 years, and its investing process hasn't changed a great deal in that time, and it's just as relevant to shorter duration, smaller volume opportunity taking as it is to generating opportunities to hold things for longer periods of time. We seek to invest right across the capital structure, take equity, invest in projects, or even lend in convertibles, etc. And the key caveat there is that it needs to have an attractive return. There are ways to engineer capital protection on that, but you need to want to own the equity, and you need to think that the project is going to deliver excellent value for Lion shareholders before putting together some kind of a structure to do it. And the way that this breaks down, just in terms of first step, second step, third step, etc., is Lion experiences a tremendous deal flow. It always has, and it's been enhanced in the recent months after we sold Parney. We've stuck our hand up to the market and said we've got an awful lot of money here which is available for investing, and the market has been coming to us. So in a given year, we would assess over 1,000 opportunities. Some of those are double ups, but most of them are unique opportunities. And the effort that goes into those could range anything from an email in the inbox generates half an hour of work, or a meeting comes through the door and it takes an hour to go through the opportunity with them, right through to follow-ons to those things, which could take days to put together a due diligence assessment, and then go into the Lion board with a recommendation to make an investment. So that, depending on the opportunity, that will dictate how much work goes into it. But there are a lot of them that come through the door, and they range from listed things to unlisted things, parties which are looking for a small loan to keep them going, or even people trying to sell projects, or in some cases originate them and talk to us about how we might support them to become co-owners in ground that isn't equitised and listed on the ASX just yet, but could produce exciting opportunities for Lion shareholders if we were to be able to float those into future markets. All of the opportunities are assessed by the in-house team here. So we've got an investment team, including the board, which has decades and decades and decades of mining experience. all the assessments that we do are done in-house. We don't outsource any of the assessments, whether they're technical or legal or anything else. We go through all of that work ourselves. And we need to be able to live with this due diligence. So outsourcing it would make no sense to us whatsoever. A large part of that work that we do is second guessing the work which has already been done and how we think the company is going to move forwards commercially into the future. And to do so, you need to have a pretty good understanding of the key people which are in those investments. If you don't know them directly, then you need to be able to check up on them. And we feel that we're 1 degree of separation from just about everybody we come across in this market. If we haven't met them, don't know them well enough to make the judgment ourselves, there's probably 5 people that we could call, which would give us a great answer on that we already do know. So it's not difficult to find out about people in the mining industry when you've been in it as long as we have. And when it comes to going on with these opportunities and having made the investment, how do they go forward? The team in here has a long experience now in the development of mining strategies, particularly for developing businesses. A large part of that is fundraising, and a large part of either going forwards or sometimes even exiting or building businesses is the M&A activity which takes place. I think in the last 5 years, we feel like we've done more M&A in the gold space in particular than just about anyone in the gold space, other than maybe Northern Star, Saracen, Evolution in Australia at least. And the things that we're seeking, stepping right aside from the commodity focus that we've outlined, we're after the lowest possible jurisdiction risk. Taking that risk out means that you can accept a lot more flexibility around the projects, because Australia and jurisdictions like Australia are highly promotable. You don't need to cross that bridge with investors before you start telling them about the quality of the investment. We need to see strong company and project fundamentals. We need to want to own the company, own the project before we start talking about making an investment. Because if we just think that it's going to be a useful trade that could flip up in the market, you're exposing yourself to a lot of risk that things don't go wrong. And that can start happening right from the get-go if you're not careful. So it needs to be an excellent underlying fundamental. And we need to be able to see deep value in making that investment. So it could be a great project, but if it's very expensive, you've already crossed yourself out of being able to get involved at that stage. That can change in time, of course. So it might just remain a watch list thing for a while. But we need to see multiples of upside. We're not looking for 5%. We're not even looking for 50%. We're looking for multiples of upside on the things that we invest in. And that takes a lot of due diligence and experience to be able to understand and assess that. Things that we're avoiding, and these are pertinent particularly at the moment, is overheated stocks, whether they're a good story or a bad story. We're not wanting to get involved in anything which really looks overheated and overvalued, particularly in the current market, which the equity market has performed quite strongly up to 2022. And we definitely want to avoid cyclical price downside in equities, projects and other things. So at the moment, our assessment of the market is one thing, and would not want to be being overly aggressive if we feel that there's imminent downside or uncertainty. We can move straight on to that. The mining market leading up to 2022, we were expressing as being 11 o'clock on the line resource clock, and you can see that on the left-hand side there. The read on where we are in the mining cycle comes completely down to liquidity, which is the amount of money which is available to flow into the sector, in some cases out. Moving from boom, which is at the bottom of this clock at 6 o'clock, right through to the top of the cycle, is basically an increase in the amount of investor attention which is flowing into the space. And it's most easily read from the behaviour of the junior sector, because the junior sector is completely dependent on the equity market to raise funding for its activities. When you start to see new floats, we were seeing that in 2016, you're coming past 6 o'clock and 7 o'clock. Exploration starts to rise, and you can see that in the series of cash which is spent and meters drilled in most jurisdictions, and we've seen a very clear pattern of that. As time goes on, you start to see more and more money go into raisings, and one of the indicators of how close you're getting to the top is when you see immense numbers of IPOs, and amongst that you see some very large mining businesses being listed. And by very large, I mean they're raising $100 million or more. In 2021, we had an absolute record year for cash raised by mining businesses, junior mining businesses, both in Canada and Australia, the two biggest mining exchanges in the world. And the new floats in Australia was the highest number of floats since 2010 or 11. It was the second highest number of floats as far back as the series of IPO numbers go in Australia. So it really was a very high year for junior resource equity issuance. And that gives us an indication that things are going quite buoyantly. It was also a year where we saw 3 or 4 very large businesses listed on ASX and then a number more globally, where in excess of $100 million was raised to bring those businesses to market. So we're seeing those big IPOs, which tells us that we're at 11 o'clock. Now, having said that, it doesn't mean that the clock is about to tick over to 12 and midnight and then go into a mining crash. This 11 o'clock can last for years. In previous cycles it has. And what we know about that time in the cycle is that it produces a lot of short-term opportunities. People can raise money, they can get work done, and they can generate results, which means that if you want to invest in a company which does have a very strong work program and is likely to develop good results, you can feel a very high sense of confidence that they'll be able to extract some equity performance from that. Hence Line's strategy to be focusing a small pool of its funds on situations that could meet those very criteria. The biggest worry I think that most participants in the equity market have at the moment is inflation. And the question really is it transitory or is it endemic? Is it embedded? And on the right-hand side, there's a very, very long-term time series of the S&P 500, 1965 through to present. There's the US 3-month bond rate as to Treasury bills, which gives you a perspective of how the two of those have moved in concert with each other. Since 2009, the 3-month bonds have offered virtually no return. It's been very, very low, virtually zero interest rate on those bonds, but for a blip starting in about 2017 and going through to 2019. Now, interest rates tend to move in response to inflation. I think most economists and market participants would accept that. And the thing which is on most people's minds at the moment is inflation. So the red line which overlies that chart that I've put on there is just to give an indication of how significant inflation is at the moment. This is US CPI, 12-month change. And it's the largest percentage jump that we've seen going a long way back. And in fact, the inflation numbers which were experienced in the 70s and the 80s were under completely different economic conditions to what we see today. We're coming out of a long, long period of quantitative easing. There's been an awful lot of money pumped into the market, which has inflated all things, equities included. And with this inflation coming along, there's an expectation that rates rise to meet that. And I think to summarise the market sentiment to that, it's sitting and waiting to see what happens. No bold decisions. Can't see too many participants selling out altogether, and that's certainly not reflected across the market. But in sectors of the market where earnings are, or businesses are priced at a very, very high premium to their earnings, such as tech, we've seen probably the highest equity price damage done. So we've seen some pretty high percentage falls in the tech sector. Now in mining, that hasn't manifest, particularly across the businesses like BHP and Rio. Mining indices have performed quite strongly. But the parts of the market that needs to raise money, such as the juniors, we've seen valuations maybe not destroyed, but certainly caught up, and performance is harder to extract. And a lot of the anecdotes which we gather from brokers and investors across the market and companies is that it is harder to raise money for juniors at the moment. So on that basis, our expectation is that 2022 won't be as good a year for capital raising for juniors. And I think to summarise the entire market sentiment there, we're waiting to see what happens with inflation as to what happens with rates and how that transmits to the equity market. Whichever way that tilts, though, Line is very well prepared. We've got an awful lot of money which is available for investing, and if the market gets cheaper, then it really does come to us, and we can play some things shorter term in the meantime if we choose to as well. So to finish up, and this is just a basic summary, there's a couple of appendices slides on this presentation which I'm not going to talk to, but you can see for yourselves. Line is incredibly well funded. As I said, if there's no investment deployments between now and the end of January, then we would sit with approximately $85 million of investable cash at that point. It's a high quality NTA. Whilst we trade at 48 cents in the market or thereabouts, the NTA of 68.8 has a high proportion of cash, value protected shares, and we expect that to be turned into cash by the end of January or early February next year. We're targeting with that funding pre-production mining investments, in many cases the things that we're seeing the equity market can't. So Line really is an efficient vehicle to be doing that within. and Lion's paying a dividend. 3.5 cents was paid in April. There's another 1.5 cents payable later this year, and a very similar pattern to repeat in 2023, and we hope beyond. So if there are any questions from shareholders, we really do invite your correspondence with us. Hit up our info line at the website. Stay tuned for updates. Sign up for those via the website if you wish, or drop a line on the office number, which is on this slide, and we'd be very happy to answer your questions. Speak to you in a quarter's time. Hedley signing out.